you have homeowners insurance, or you have renters insurance. So you start thinking about like, okay, am I at risk of losing my home? Could I rebuild my home if something were to happen to it?
Yep.
Could I buy a new car if something were to happen to my car? That's where I would say is that people need to start making a list of their risks and then matching different insurance policies or cash reserves.
Welcome back to the Retirement Fiduciary Podcast, a place where we have authentic, no BS discussions about retirement planning, investment strategies, and wealth management. Whether you're approaching retirement or if you've already made work optional, this show is for you. Now, here's your host, Adam Koós, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group at libertaswealth.com.
All right, everybody, welcome back to the Retirement Fiduciary Podcast. Today's guest is Tony Steuer, a financial readiness advocate and award-winning author who helps people prepare for life's financial what-ifs before they happen as opposed to after. Tony has more than 30 years, that's 3 decades of experience in insurance and financial literacy, and he's the creator of the Financial Readiness Plan, a framework designed to help families organize their finances, reduce risk, and be better prepared for unexpected life events. He's also the host of the podcast Get Ready Before Life Happens, where he shares practical strategies to help people strengthen their financial lives before problems arise. So today what we're going to do is we're going to talk about overlooked risks, common insurance mistakes, scam red flags, which is what I'm looking forward to, and what it really means to be financially prepared. So Tony, thank you so much for joining. Welcome to the show.
Yeah, thanks, Adam. Glad to be here.
Yeah, for sure. So when you say financial readiness, we were talking offline, what does that actually mean for just the average Joe and Jane?
Well, what it means is that you're actually prepared for different things that can happen along your financial journey. So it's more than just insurance. It's about thinking about, okay, what if this happens? What if that happens? What's my plan?
Yeah, and why do you think so many people wait? I like to say sometimes it's like they wait to step on a landmine before they make a plan, right? So why do you feel like so many people wait until some crisis happens before they actually start getting organized?
I think it's just human nature, is because they're not aware really of what might happen, and the importance of planning is like, I live in California, so earthquakes are a big thing out here. So you would think everybody would have an earthquake preparedness kit and supplies in case an earthquake happens. They don't. I know our supplies are probably a little bit out of date and I need to update them. So I'm just like everybody else. So it's one of those things that's like, okay, there's the risk that this might happen. Then I have to take the time to figure out how to address that risk. Then I actually have to go ahead and do that. And there's so many things happening in our lives. If we have kids, we have adult parents we're taking care of, we have our businesses, we have our partners. So all these things take away the attention that we need to attend to getting ready before different things happen.
We're just busy, right? Life happens, right?
Exactly.
Yeah. So what should every household, every family have in place right now with no regard to how much money they have, their net worth, and so on?
Well, so the way I think about it is to think about what risks you have. Because I think we oftentimes think about, in the insurance world, somebody comes up to you, your best friend says, hey, Adam, you need a whole life policy. And then you start thinking, okay, do I get this whole life policy or not? Instead of thinking like, okay, what are my risks? So I would start with a risk assessment, thinking about like, okay, am I at risk of not being able to pay for a medical bill? Or am I at risk of not being able to pay for an emergency car repair? In that case, you need a very small insurance policy called an emergency fund. And that's all an emergency fund is. It's insurance against the risk of a small cash payout. Then you take a look and you say, okay, I have a steady income. If something happens to my income, I don't have enough cash saved, so I need disability insurance. That's a risk of losing income. You have health insurance for the risk of losing, or not of losing your health, but of having a health event. You have auto insurance because you're at risk. Well, most states require auto insurance. You have homeowners insurance, or you have renters insurance. So you start thinking, okay, am I at risk of losing my home? Could I rebuild my home if something were to happen to it?
Yep.
Could I buy a new car if something were to happen to my car? So that's where I would say is that people need to start making a list of their risks and then matching different insurance policies or cash reserves to that. For example, with long-term care insurance, some people are able to self-fund because they save enough money in their retirement plan so they don't need a long-term care insurance policy. So that's the better question that I think people should ask. What are my risks instead of starting off with, do I need this insurance policy?
Yeah. And then I'm full disclosure, I have, I think three different disability policies because I don't think any of us want to die, but one of the worst things that could happen is that you don't die in some kind of car accident or something that turns you into a vegetable. And imagine kind of your family having to make the decisions as to whether or not to keep you alive. Maybe some of those decisions are easier than others if you're completely and totally incapacitated. But if you're not, that could be pretty rough. So life insurance, I'm curious though, do you have an opinion? I was just talking to a client today about something that they called, I've heard them called LIRPs, life insurance retirement plans. I've heard them called ELIPs, executive life insurance plans. But today was the first time I've ever heard it called an infinite cash plan. Thank you.
Oh boy, this is one of my favorites.
I'm so glad you laughed at that because first of all, I didn't know what they were talking about. And then I looked it up, I Googled it and I thought, oh my God, this is the new marketing name for LIRPs. So my opinion is that you max out your 401k plan, you reduce your taxable income. The next step, obviously emergency money comes first. Having emergency money, being properly insured, those are first. But once you've done that, max out your 401k, reduce your taxable income, unless you don't have much taxable income, of course, then maybe it's a different story. Next, max out Roth IRAs if you're eligible, or do backdoor Roths. Next, put money in a brokerage account so you have money that's, I call it additional emergency money that's growing for you above and beyond your emergency money. Then, if you still have a bunch of money left over, maybe then looking at a life insurance retirement plan, ELIP or infinite cash plan, whatever you want to call it, might make sense. Do you share that opinion or do you disagree with me?
I say that they're the worst thing out there, period.
Wow.
No matter what, for almost everyone.
Didn't expect that. Okay.
Certain circumstances where they can make sense in advanced planning situations. Sometimes maybe you have a private placement for a very wealthy executive. I've seen them used as handcuffs, golden handcuffs, where there's a death benefit to the company if the employee passes away. Otherwise, there's a cash value that goes to the employee as a bonus. But aside from that, what you're talking about, it's called the infinite banking concept, be your own banker, missing money concept. LEAP is another name for it. All they are is just ways to sell cash value life insurance. So if you strip out the fancy name, all you're talking about is a cash value life insurance policy. Right. And so we can break it down whether people need permanent life insurance, and there are very rare cases where they need permanent life insurance, and there are even rarer cases where they need permanent life insurance that builds a cash value. So let's take a look. Do you want me to get into be your own banker a little bit?
That's fine. In fact, I'm just ecstatic that you agree with me because, I mean, our listeners and our watchers come behind the beaded curtain for a second here. Because I didn't plan to ask you that question. I just thought, you know what? I had this discussion today. You brought it up. So I was just talking about it to somebody else. I thought, what would happen? What's he going to say? And I was concerned that you might completely disagree with me and you might be a huge advocate, which wasn't going to be a problem at all. But I share an opinion that oftentimes I can't get insurance agents to tell me why, ethically speaking, it makes sense for people to fork all this money into whole life policies other than for the fact that it pays a high commission, but that doesn't have anything to do with ethics now, does it? So I digress, but yeah, go ahead and just jump right into it.
Okay. So one is I've been advocating against that type of crap all my career. So
there we go.
Because that's essentially what it is. As you point out, when you get an investment, you get the investment. When you're buying a life insurance policy, the first thing that people miss is on the very first page of the contract, it says, this is a life insurance policy. This is not an investment.
Yep.
So that's the first thing that people miss is you're paying for insurance. And if you don't need the insurance, then you're paying a heck of a lot for a very expensive insurance policy, because if you're buying a whole life insurance policy, the company is pricing out the premium to take you at age 100. So it's going to be pricey. Then you have the liquidity issue on a cash value life insurance policy. Most full life policies, the surrender value goes up to 16 years. In the first year, the surrender charge is 100%. So if you're your old bank, would you charge yourself 100% surrender charge on your money? Most likely not. And then they say, oh, well, you can borrow out all the money because you're going to be rich. You have all this money in a contract. Well, what they don't tell you is that the insurance company is charging interest on the money that you take out of the contract. So you're paying that interest. So you have your money locked up.
Yep.
It takes, on those contracts, it takes 10, 20, 30 years before you have enough cash value to actually borrow money out. So it's not a very liquid investment. And then if you take that money out, you don't have from the death benefit. It's taken out from the death benefit. And if you borrow too much or withdraw too much, the policy collapses and you can even have a phantom income tax gain. So that's just off the top of my head, all the things that can go wrong with it.
I love it. One of the things I like to, when I do speaking engagements, when I'm on stage and I'm talking about this stuff, I like to talk about some of the maybe not so well-known facts that are out there. Like, for instance, you mentioned the surrender charge that can go out 12 years, 15 years. And I'll tell people that, and this is true, and you can tell me if I'm wrong, but the surrender charge exists so the company makes back the commission that was paid the insurance agent. So the reason it exists there is because they paid a pretty nice little commission, and they pay actually a renewal commission every single year when money comes into the policy, and that clock starts all over again, by the way. But that's what the surrender charge is. It's the same with annuities, but we're not going to get into annuities right now. And then, I'm glad you mentioned you're not taking money out of it later on. You're borrowing against it. You're borrowing against yourself, which might sound really cool if you watch a TikTok video or an Instagram reel with somebody who doesn't know what they're talking about. But at the end of the day, like you said, if you borrow too much and you don't put that money back, now all of a sudden you're paying tax. You've lost your death benefit. There's several insurance companies around the country. If you go to their offices, the buildings are usually made with marble or granite. The lights are on. People are wearing clothes. The water's running. They're not working for charity, that's for sure.
Yeah, I mean, insurance companies are some of the biggest real estate investors in the country. If you want to talk about massive real estate portfolios and investors in securities and things like that, it's insurance companies. Insurance companies move pension funds. They move markets when they make their investments. And like you said, they're not doing this because they're nice guys and because it's easy to get over on them. That's the thing that drives me crazy is like, how do you think you figured out some secret that an insurance company who hires, the insurance companies may be bad at a lot of things, but they do hire the smartest mathematicians called actuaries. So for people who aren't familiar, so actuaries are the ones who set the premiums and they set the rates on all the stuff, and they're not always right. They're human, but they're the best mathematicians of the world. And so you're trying to get over on the best mathematicians. So if you're really smart, you might be able to get over on them, but most likely most of us are not going to be able to because that's what they do all day.
No, it's every once in a while, once a year, I'll hear somebody say that I don't like investing in the stock market. It's like a casino. It's like I think that the insurance industry is more like a casino than the stock market. But anyway, you've talked about life insurance. A good segue, actually. We were talking about borrowing and then how you can pay tax. The life insurance policy blows up. You talked about life insurance dying before the person dies. Can you explain that?
Yeah, so what happens, and this is actually going to be a bigger and bigger issue in America, possibly in other countries, is there are all these policies out there that are dependent upon certain projections. And those projections, there's basically three components on a life insurance policy, no matter what type of policy it is. There's the earnings, which can take the place of interest on a universal life policy. It's dividends on a whole life policy. It's indexed returns on an equity indexed life insurance policy. So you have that component. So you have the assumption that earnings are going to be a certain percentage. Then you have the mortality cost or the pure cost of insurance, which is another lever that the insurance company can turn. And then you have overhead expenses. So as you said, some of it is to go back for commissions, but some of it is to pay for the lights and to the buildings, the cost of administering the policies and everything else. So you have those components. And so what happens is if the policy doesn't earn enough interest and the company hasn't increased the premium, the policy is going to collapse at some point, is because the policy is sold out. I mean, you've seen insurance illustrations. The companies project out values based upon the current interest rate assumption. The one thing I can tell you with 100% certainty is interest rates are not going to stay at that constant level for years.
Right.
It doesn't happen. And so that's the thing is the insurance company has said, okay, we're going to project this out. It's going to be 7% for 30 years. There's going to be no variation. Well, we both know when there's variation, that means returns are impacted, which means there's not as much cash value growth as the company is projecting. And when there's not as much cash value growth, that means the insurance company is taking more out to pay for the pure cost of insurance, which means that the overall returns get bent down even further. So that's just a very surface look at what can go wrong with insurance policies.
Yeah, we used to see a lot of that in the 2000s. I started my career in 2001, 10 days before the World Trade Center went down. And we used to see a lot of policies from the 80s and 90s that were illustrating these enormous interest rates that just obviously rates just kept coming down and down, so that the policies were all screwed up. And when you did something called an in-force illustration, so that's something that everybody can do, is call up your insurance company, ask them for an in-force illustration. They'll usually email it to you. Some of them will force you to mail it and wait for snail mail because their ears perk up because they start worrying that you're going to transfer it and they don't want you to do that. You might have a little trouble getting it, but once you get it, it'll tell you how long the policy is going to last based on the current market or prevailing markets, interest rates and so on. And you'll see right on that in-force, it'll tell you that at current rates that, let's just say the policy dies on you at 62 years of age or 68 years of age. And it's okay. I didn't know that. Not only is my policy dying, but all the cash that I put into this thing is getting chewed up over time because interest rates aren't high enough to keep up with their illustration that they built the policy with. So there is a such thing, in my opinion, of reviewing your life insurance policies. Whereas I think most people think you said it, you forget it, you never look at it again. I think that's not a good way to go. So speaking of mistakes, what would you say are some of the common mistakes that people make with life insurance after they retire?
One is continuing it.
Yep.
The majority of us, if we've saved enough money for retirement, the odds are that we don't really need life insurance. Yeah, maybe having some liquidity helps if you're a real estate investor. I've had clients who are real estate investors, and yeah, they need a lot of life insurance because there's no liquidity in their investment holdings. But for most of us, if we're invested in typical assets, if you're invested in an index fund, it's pretty liquid. So you have that liquidity there. So that's the number one mistake. So just to go back to in-force illustration is you should have an in-force illustration run every 2 to 3 years.
Mistake.
So for anybody watching and listening, if you want to message me, I'll send you a letter you can send to request an in-force illustration. So I have one for whole life policies. I have one for index. So whatever type of policy you have, I'll send you one so you can take a look at it. I have a presentation. I don't know, Adam, if it's posted. So remind me, or listeners can remind me, called Don't Let Your Life Insurance Policy Die, that I give to advisors and financial planners. But it's good for anybody. So that's just to address that. So sorry I walked back to that.
You're
But
good.
in terms of the mistakes that people make is having the wrong type of units. And that gets back to the whole risk protection thing that we started with is you can use the cash value. So let's say you've got that fat whole life insurance policy that you bought because your college roommate talked you into it, and your college roommate is now off doing something else because most people are out of the life insurance industry after 4 or 5 years anyway, but you still have that whole life policy, or you have 4 or 5 whole life policies you picked up along the way, is you can use a tax-free 1035 exchange to a long-term care insurance policy. Yep. So you can get some coverage you actually need. So that's one thing. So yeah, the biggest mistake is just hanging on to the thing. But the second biggest mistake is assuming that everything is going to be fine. Because the one thing insurance companies do not do is they bury their heads in the sand and they don't tell their policy owners that a problem is coming on. Even if a policy will lapse in the next 2 years, they don't send out a letter saying, hey, Adam, it looks like your policy's underfunded. You need to do something today to keep the policy in force. They wait till the policy is about to lapse, and instead of saying, well, this year you've been paying $1,000 a year, well, to keep the policy in force, all of a sudden you have to pay $10,000 a year. And it's like, can you have told me that like 20 years ago? But they don't. Yeah. So those are the big issues that I would hit home for people.
I want to highlight this because I'm not sure if you've seen these YouTube shorts or Instagram reels, TikToks that are going around. It's like a theme or this viral thing people are doing where they take the song by Google Dolls, Iris, and they start, it's usually like a celebrity who's in their 50s, and they're like, this is what was I like in the 90s? And then they go back and they show pictures or videos of them in the 90s. And somebody posted this one, it said, gas prices, what were you like? What were you like in the 90s?
Oh, wow.
And it takes me back to when I started driving. I'm dating myself here. I remember going to the Clark station on Main Street paying 89 cents a gallon. And so when you talk about something that I am extremely passionate about when it comes to insurance, there's so many things that we're obviously already hitting a lot of the things that fire me up. And I'm so glad that you agree with me, because I wouldn't get fired up at you. I would never do that to a parent.
I appreciate that. Thank you.
No, but on social media, like our social media accounts, like there's some things that I get pretty passionate about, and I love it that you're just as passionate about me, because it's like you tell somebody, he says, my insurance agent said that I needed to have this permanent insurance, because if I do term, then I'm not going to have any insurance when I'm like 60, 65 years old. And think about it, like the Goodalls thing, right? Gas prices were 89 cents, 90 cents a gallon when I started driving in 1994. I mean, if you buy whatever amount of permanent insurance it is that you think you need, or your insurance agent says you need, whether they do a needs analysis or not, by the way, is another discussion altogether. Do you really think that death benefit's going to be meaningful at all in 40 or 50 years when inflation has taken hold and destroyed the value of the dollar once again, right? Today we're paying $4, $5, $6 a gallon compared to 80, 90 cents. That life insurance isn't going to matter anymore. And contrary to popular belief, and you already said this, but I just want to highlight it, the older you get and the more you save, the more money you have, the less insurance you should need. It shouldn't be the other way around. You shouldn't be spending so much money that your wealth is declining, so you need more insurance to replace your income or make your spouse somebody's sugar mama someday. So anyway, I digress. How common is it, you mentioned this before, in your experience, how common is it to see beneficiaries that are completely unaware that a policy exists that they are the beneficiary of, or how to claim it for that matter?
It's super common, which is one reason I wrote the financial readiness plan that I'm just releasing, is so people can document all these things to give to their heirs, to leave behind for their heirs. So basically what it is, I wrote it because my wife and I redid our will and trust a few years ago when our son turned 21, and our attorney said, write a letter of instruction. So the problem with the will and trust is they only provide you the documents, but they don't provide context for things, including beneficiary designations. And I can tell you, as a life insurance consultant, I can't tell you how many times that I also saw ex-spouses as the beneficiaries on insurance policies. People don't update their beneficiaries. So there's two parts of it. There's one is you need to update it. Two, you need to tell somebody about it. And if you don't want to talk to them about it, so let's say you have a kid and you don't want your kid to know that there's a life insurance policy on, that they're the beneficiary, you can leave them a letter that they open when you die.
Yep.
Leave it with your attorney if you have an attorney. Otherwise, leave it in your desk. Everybody's got a drawer. Everybody has access to a letter. I mean, I'd love it if people used my financial readiness plan, but you don't have to do that. You can just write a letter saying, hey, I have a life insurance policy with Prudential. Here's the policy number. And that's all you need. You're the beneficiary. You don't even have to tell them in advance if you don't want them to know that there's money out there. So it's pretty easy. But yeah, that's a huge thing. So there, unclaimed property, there's billions of dollars in unclaimed property in the US. So there's a lot out there.
We do this thing at our office that all started from the passing of my brother. He was 13 months younger than me and divorced for 2 years. Mom wasn't really in the picture at the time, so we had full custody over 4 kids. One was autistic, or is autistic, and he fell asleep on his motorcycle. And this is 9 years now, so it's been a while. And the financial guy in the family, it was my job to go up and try to make some sort of order out of this mess. And while we were super close, we couldn't have been more different. His idea of planning was what I'm going to do in 5 minutes, right? But when I got up there, I couldn't find the password to his laptop. Couldn't pay his bills, couldn't find his bills, couldn't find the deed to his house, the titles to his 3 cars. He was a mechanic, so he had a couple cars. I couldn't find his life insurance. I knew he had life insurance, but I couldn't find it. And when I finally did find it, he didn't tell anybody, but he'd just been laid off 2 weeks prior. So there was no life insurance for the kids because it was all through his employer. He didn't have any personally owned life insurance. So it was a total nightmare. And when I came back to Columbus from Cleveland, I told my wife, Donna, I said, I promise you will never have to go through what I went through with Kyle. Because what I realized was, even though I'm in this business And I thought I was a rock star because I had a testamentary trust and a living trust and guardianship provisions for the kids and a healthcare directive and powers of attorney and financial powers of attorney, that if I were to kick the bucket, my wife doesn't know how to get into my server. I have 3.5 companies I'm paying bills for. How is all this stuff, right? What are my passwords? So I started this thing for our family. And then when COVID happened, we went from having 25 appointments a week to having 3 appointments in 8 weeks. And so things got really quiet around here. Happy hour got earlier every day, as we all know. But if you walk down the street, everybody's recycling bin sounded like glass. It's this kit we get for all of our clients where we get a fireproof safe.
Oh,
There
nice.
are red files in the front, which are their emergency files, so estate planning documents, a password organizer, a place to put their passport, insurance policies, insurance statements, brokerage statements, bank statements. Their entire financial house goes in this kit. And then we upload it to an online encrypted vault we call the My Promise Vault, where the executor or trustee can have third-party access to it. So when they log in, they see Tony Steuer, address, phone, email. That's all they see. But heaven forbid something happens to Tony one day, and we get a phone call and say, hey, I got bad news. Tony, we lost Tony in a car accident. What do I do? We flip the switch, and now we have access to everything that we need for Tony's spouse at a time when the last thing we want to worry about is money, right? So I think that's huge. Like having some sort of plan, financial readiness. I'd like to learn more about that because it blows my mind that anybody wouldn't even know that they're the beneficiary of a life insurance policy. Or something you said a second ago about healthcare directives, things like that. I've got a friend who was divorced and remarried, and he forgot to update his healthcare directive. He ended up in a hospital. He was non-responsive, and his wife couldn't help him because his ex-wife had the directive. That's not good, you know?
Yeah. You definitely don't want your ex-wife to have that direct.
Good riddance. But anyway, Howard, a lot of talk about AI these days. I hear about something from someone about AI daily, literally. So how would you say technology and AI are changing the scam landscape when it comes to, so we're changing gears here, talking about scams for consumers?
Not good. Is that a good way? Is actually, I recently posted about this on LinkedIn. There was one scam. So my wife and I were going on vacation this summer. So we're staying at a hotel. So I got an email from the hotel, and the email looks like it's from the hotel. The return email address was the name of the hotel, but it was more the name of the hotel at Gmail
Right.
rather than the domain of the hotel. But it had the dates we're staying in the hotel. It had a reservation number. It had how much we were paying.
Wow.
And it had my wife and I, it had our names. So it turns out that somebody had hacked into the hotel server and stolen all this, but they created these things and it said, please confirm your reservation online within 24 hours or you're going to lose your online reservation. But it looked really good. And if I didn't know better and I wasn't just talking about scams all the time and red flags, I might have fallen for it. It was really good. And so that's an example of how AI is doing it, but it preys off the same things that scammers have always preyed on. It had a time-sensitive aspect to it. So it pressured me. It's like, we're going to lose our reservation if I don't confirm in 24 hours. Well, I don't want to lose our hotel reservation over the summer. It's like, one, I don't want to lose it, but my wife is really not going to be happy with me, and I definitely don't want that. And then it has the other things because it had enough information to be psychologically manipulative, because that's what the best scammers do, is they reflect on you what they think you want to hear. That's what makes scammers so effective. Is if I was trying to scam you, Adam, I would ask you questions about yourself and try to learn about you and then reflect back at you and say, look, if you say you're interested in crypto, then I would talk to you about some kind of crypto scam. But that's what scammers do. And we hear about these romance scams and all these other scams. And that's what they're trying to do, is they're trying to get enough personal information to personalize the scam for you. And that's what this email did. And that's what AI does, is it allows scammers to personalize the scams for you. And I've had some guests on my podcast who are specialists in this area. They run cyber fraud organizations. And the thing is they all agree that if you haven't been scammed yet, it's just a matter of time. The right scam hasn't been designed for you. And there's whole centers set up in Asian countries where people are in these call centers
Oh
and
yeah.
they've been kidnapped, and their job is to scam people every day. And so that's the problem. And with AI, is they are being customized to scam for you, a scam to fit exactly who you are. And the more they have a psychological profile of who you are, what you're more likely to fall for, getting the information from these hacks, because that's the first time I've seen that kind of personalized information put into a phishing email directed at me. Because normally phishing emails are like, you want a Lowe's gift card or
Yeah, yeah.
something like that. So yeah, I think AI is going to make it that much worse.
Yeah. No, we had a client whose mom was scammed, and I think it was still through snail mail, where they wrote her and said that they were in Australia. They were being beaten by somebody, their father or something like that. They sent pictures of two kids being beat up and said that was them. And I think this was partially early stage dementia was part of the issue, but she started sending money. And by the time she got up to sending more than $100,000 to these people, she got a home equity line on her house and started sending money from her home equity line. And when we finally caught the situation and started working on stopping her and got the FBI involved, it got crazy. The crazy part of it, no, I shouldn't say crazy, but the sad part of it was the mother was so convinced she was helping that she became infuriated when she was told to stop. And she thought, no, I'm helping these people, and you're keeping me, and what's going to happen to them if I stop? So it's so sad. And my kids watch this YouTuber that hacks into these scam centers overseas and basically finds out what their names are and then freaks them out on the phone. So that's fun to watch. But what trends are you seeing right now, current day? What kind of scams are you seeing out there to watch out for?
Well, the one that I mentioned, but the other scams that are happening are it's usually the same scams that there've always been. They're just packaged differently. There's scams that are aimed at our aging parents. What you mentioned is a friend of mine is a researcher in aging, and basically all of us have some form of cognitive decline after age 60. And counterintuitively, with that cognitive decline is we become more susceptible to taking risks and being subject to fraud. So we're seeing that leverage.
Yeah.
We're seeing more psychological manipulation, but it comes back to the same things. Is scammers try to isolate you. They try to play on your emotions. They give you a time sensitive thing. They tell you they're letting you in on a secret. I would imagine that they told your client to not tell anybody about this. Like,
Well,
hey,
sure.
Adam, I got this deal for you. It's in this company. Nobody else knows about this. It's an opportunity. Don't tell anyone about it. Don't even talk to your wife about this. And you need to make the investment by tomorrow, because that's when everything else is going to be made public and nobody else is going to know about it. So you have all the classics right there. I gave you a time deadline. I isolated you. I'm giving you a little bit of pressure. And then I'm pumping up your ego that you're the only one who knows this. And that's the way scammers play is the type of scam is varying, but it still comes to the same thing. The big scam that's happening also are the fake calls from grandkids. Is like, grandpa, I'm on vacation in Mexico and I'm in jail and I need you to send $10,000 so I can get out of jail. And that's a really popular one, because with AI, they only need like 10 to 30 seconds of your voice to make a flawless recording. So the advice I'd give to everyone is to have a passphrase, something, maybe some weird vegetable or something that only people in your immediate family know what that is. And you ask them for that passphrase. Or you ask them a question. So like, hey, Adam, do you remember what you wore to your senior prom?
Yep.
Probably scammers aren't going to have access to that or be able to answer that question quickly enough. But you're going to be able to answer that question quickly enough. So that's the kind of thing that you want to have set up with your family. Is you want to test those things out, because that's what AI can also do really good. Is they can create a video of you with your voice and make it be pretty darn good.
Yeah. And what should someone do if, let's just say, they find out or think even remotely that their parent or their spouse is being targeted, or maybe they find out they've already been targeted? What would they do? What should they do?
That is a hard one because, as you point out, there's going to be some defensiveness. Nobody wants to admit they've been scammed, but what happens is scammers starts becoming their buddies. So just like in this instance, is counterintuitively, your client started getting upset with you for meddling in the situation. So the first thing to do is to communicate and have a conversation and try to find out what's going on from their angle. And then you can start sort of working it as best as you can, is talking to them saying, hey, I don't know if this is a good idea. Let's talk this through some more. Is because it is very hard to convince somebody who's being scammed that they're being a victim, because people who are scammed usually become victims again. But it's really about just talking to them and trying to find out what's going on, and then trying to, because you can't ever convince anybody that they're wrong. But what you can do is you can provide more information so they can change their mind. And that's the way to do it. And you can't be angry at them and saying, Mom, this is really stupid. How could you send money to this person? I mean, clearly it's a scam. That's just going to shut them down and you'll never get anywhere. So it's like you have to reserve judgment. If you want to scream into your pillow later on, that's okay. But you have to be very patient, especially with somebody who's older, because they're already losing some of their freedom and their mobility. So they're going to be very protective of some of the things that they're doing because they think that it's another power that they're losing. So
That
it's
makes
all
total sense.
communication.
Yeah. Soft communication, careful communication. Yeah. So just to close up here, I feel like I can't believe how long we've been talking. I've had so much fun. So this has been great. But if somebody listening or watching wants to start becoming more financially prepared, period, whether it's insurance related, financial planning, retirement planning, avoiding scams, anything we've talked about today or otherwise, where should they start in your book?
I would say podcasts are a great way to do it. Find somebody that you connect with who's legitimate. So like, you have a legitimate background. You're a financial planner. You know what you're talking about. So if people are out there looking for personal finance content, there's a lot of CFPs who have podcasts. Listen to somebody who's a professional. Yeah, sometimes it may be dry, but you'll find somebody like yourself who has on guests who are good. You have a good conversation. And so that would be one thing I'd say to people. I would say learn as much as you can to be curious. So the whole point of my work right now is to help people ask better questions, because I think that's your best defense against fraud, is by being curious and asking more questions, because fraudsters don't want to ask questions. They want to just give you information. So my whole thing is to ask questions. And if you think about it, like before you buy a new TV, most of us ask a lot of questions before we buy a new TV. Ask that many questions before you enroll in your company's 401k, before you go through your employee benefits. Ask questions, be curious, and get answers. I mean, AI right now can give you some pretty darn good answers. You know, you don't want to rely on AI because it's not always accurate.
Yeah.
But it can help give you some background and what it can do. So if you're going to sit down with a financial planner, you can tell AI, hey, I'm sitting down with my financial planner, Adam, next week. What are some questions that I should ask him? And that helps you. It's like when you go to see your doctor, you have questions usually before you see your doctor that you want to ask your doctor to maximize your time. And it's the same thing, is just figure out what questions you want to ask to get the information you need to make an informed decision.
By the way, do you know what the word is, the technical IT word is for when AI doesn't give you the right information? Have you heard this yet?
They get manager?
It's called hallucinating.
Oh, yeah, that's right.
They're called hallucinations. That's the technical term for AI giving you incorrect information. So anyway, Tony, this has been awesome. We could probably do this again sometime. So thank you so much for joining us, sharing all these insights. Again, I think there's probably more we could branch off into today, but these are the kind of conversations, as you mentioned earlier, helping people avoid problems long before they happen in the first place. So for those of you that are listening, if you'd like to learn more about Tony, his financial readiness plan, or his podcast, go check that out. It's Get Ready Before Life Happens. So be sure to check out the links in the show notes for this episode, as well as other episodes he's done. And then Tony, of course, thank you for joining us again. And as I always say, there's thousands and thousands of podcasts out there. You chose to give ours a listen today. So thank you so much for joining in, and we'll see you next time.
We hope you enjoyed today's episode. If you like a second opinion on your retirement plan or investment strategy, please head over to libertaswealth.com. This podcast is for informational purposes only and should not be considered as legal, financial, tax, or as the basis for investment decisions. Always consult a certified financial planner or a fee-only fiduciary advisor before acting on any ideas discussed.